Hello guys, welcome to our video. On today's videos, me Wardah Fahira and my partner Nomi Rumondang will talk about behavioral aspects of responsibility accounting. Without further ado, let's get into the video. What is responsibility accounting? Responsibility accounting is the term used to describe an accounting system that plans, measures, and evaluates organizational performance along lines of responsibilities. Responsibility centers are segments of the organization that are accountable for certain tasks. It is assumed that there is one person in the responsibility center who has control over those tasks. Each responsibility center in the organization is charged only with the revenue and costs over which it has control. Next is responsibility network. Responsibility accounting is based on the premise that all costs are controllable and the problem is only establishing the point of their controllability. For this purpose, the company's organizational structures is broken down into a network of individual responsibility centers or into organizational units engaged in the performance of a single function or a group of closely related functions having a single head accountable for the activities of the unit. In other words, each unit of this organizational network, or more specifically the individual in charge theory of, is responsible for performing some function and for using resources as efficiently as possible in performing this function. To create an efficient responsibility network structure, responsibilities and scopes of authority for every individual, from the top executive down to the lowest level employees, must be logical and clearly defined. Responsibility shouldn't be shared by two or more individuals because division of responsibility can invite misunderstandings, confusions, duplication of efforts, or neglect in performance. It also makes it extremely difficult to determine who is at fault if something goes wrong. Now we're going to talk about types of responsibility centers. There are some types of responsibility centers. First, cost centers. Cost centers are areas of responsibility that produce a product or render a service. Managers in charge of cost centers have discretion and control only over the use of the physical and human resources necessary to accomplish their assigned tasks. They have no control over revenues since the marketing function is not their responsibility. Investment decisions such as buying additional machinery or increasing the inventory of raw materials and supplies are made at higher organizational level. Next is revenue centers. If the primary responsibility of segments managers is revenue generation, their segments should be treated as revenue centers. Managers in revenue centers have no discretion or control over aside investment or the cost of the items or service to be sold. They have control only over direct marketing costs, and their performance will be measured in terms of their ability to reach predetermined sales goals within specified expense restrictions. Number 3 is profit centers. Profit centers are segments where managers have control over both revenues and expenses. Managers are evaluated on the basis of their efficiency in generating revenue and controlling costs. Their discretion over costs includes the expenses of producing the products or rendering the service. Their responsibilities are broader than those of cost or revenue centers managers because they are responsible for both the distribution and manufacturing functions. Last but not least is investment centers. Managers of investment centers are responsible for investment in asset as well as control over revenue and expenses. They are responsible for attaining specific contribution margin and profit goals and for efficiency in asset utilization. They are expected to attain a healthy balance between profits achieved and the investment in resources used. Organizational structure. There are two types of organizational structure. First, vertical structure. In a vertical structure, organizations are broken down by major function. The overall responsibility for production, sales, and finance functions are assigned to vice presidents, who delegate their responsibilities down the hierarchy. The final responsibility for each function, however, ultimately rests with them. From a responsibility center's viewpoint, our production segments are cost centers, since revenues are only generated through the sales function. Sales segments are revenue centers, since the various managers are responsible only for selling the products or services and have no control over the cost of producing them. Only the president has control and discretion over all activities and has the final say in accepting or rejecting investment proposals. Next is horizontal structure. In horizontal structure, the breakdown could be by product or geographical area. Each vice president controls a profit or investment center rather than a functional cost or revenue center. They are responsible for production, sales, and financing, or in other words, for all functional areas within their districts or for their product groups.
Next, fixing responsibility. After selecting the type of organizational structure, the next crucial task in constructing a behaviorally effective responsibility system is to delineate responsibilities. Most people welcome responsibility and the challenges it represents. Being held responsible for something makes people feel competent and important. It implies decision-making authority and may motivate them to improve their performance. Responsibility is a job satisfier. Without it, morale will suffer. The favorable behavior effect of assigning responsibilities for specific functions to individuals is supported by empirical research. Unfortunately, the interdependency of the various segments of an organization frequently make a clear-out delineation of responsibilities difficult. The most crucial factor in the delineation of responsibilities is the degree of discretion and control over the resources required to carry out the delegated task or function. Since control in a work environment is rarely complete, significant influence is frequently considered as sufficient to pinpoint responsibility. In 1956, the Committee on Cost Concepts and Standards of the American Accounting Association issued some guidelines but warned that their application must be tempered by good judgment and common sense. They recommended that, first, the person with authority over both the acquisition and the use of goods or services should be charged with their costs. Second, the person who can significantly influence the amount of cost through his or her own actions may be charged with the cost. And third, even the person who cannot significantly influence the amount of cost through direct action may be charged with elements with which management desires that person to be concerned, so that he or she will help to influence those who are responsible. Next, planning, data accumulation, and reporting by responsibility centers. Responsibility budgets. To proceed chronologically, we prepare budgets that assign cost and revenue goals to each network segment. This will be the basis for evaluating the performance of the person in charge of each organizational unit. The characteristics of responsibility budget is that responsibility center managers are assigned performance goals only for those revenue and cost items over which they have control. The budgetary process is most effectively started at the lowest organizational or network level, for which budgets are to be prepared and then passed upward through the chain of command in a pyramid fashion. Next, data accumulation. To facilitate periodic comparisons with the various budgetary plans, the accumulation of actual income and expense items must be necessarily follow the responsibility network pattern. This requires a three-dimensional classification of costs and revenues during the data accumulation process. Costs are classified first by responsibility center, secondly, within each center by whether they are controllable or non-controllable, and third by cost types, or by line items such as salaries, supplies, materials, and rents. This type of data accumulation provides management with information pertinent to several dimensions of its operations. Next, responsibility reporting. The end products of responsibility accounting systems are periodic responsibility or performance reports. These reports are the media through which costs are controlled, managerial efficiency is measured, and goal attainment is assessed. This control device reports what happened both by account and by the functional responsibilities of individuals. The performance reports are distributed to top management and to lower level managers. To enhance efficiency, responsibility reporting systems should be based on the so-called pyramid reporting or telescoping principle. This means that each responsibility manager receives only his or her own control report, and that the lowest level detail reports are issued first. Only their total are then carried to the next higher reporting level. The net result is that the higher the responsibility level, the more condensed the reporting becomes. Next, behavioral assumptions of responsibility accounting. Responsibility planning, data accumulation, and reporting systems are based on several assumptions concerning operational and human behavior, including first, management by exception or MBE is sufficient to control operations effectively. Second, management by objective or MBO will result in agreed upon budgets, standard costs, organizational goals, and workable plans for their achievement. Third, the responsibility and accountability structure coincides with the hierarchical structure of the organization. Fourth, the managers and subordinates are willing to accept the responsibility and accountability assigned to them through the organizational hierarchy. And fifth, responsibility accounting systems induce cooperation rather than competition. Management by exception or MBE. Management by exception assumes that to most effectively manage and control organizational activities, managers should concentrate their attention on areas where the actual results deviate substantially from budgeted or standard goals. Proponents of this approach claim that it results in the most efficient use of scarce management time, concentrates on correcting inefficiencies, and reinforces desired action. Next, management by objective or MBO. Responsibility accounting facilitates management by objective or management by self-control. This is a management approach designed to overcome the numerous dysfunctional human responses triggered by attempts to control operations by dominance. To get optimal motivation and communication from both management by objective and the responsibility accounting system, certain favorable environmental conditions must exist or be perceived to exist. These include: first, in setting responsibility-centered goals, top management must provide overall direction by specifying the company's overall objectives and goals. Second, In the joint formulation of detailed performance goals and action plans, top management and responsibility center managers must maximize the congruence between the personal needs and career aspirations of work groups and overall company goals. Third, motivation is enhanced if people believe that the achievement of company goals will simultaneously satisfy their personal needs. And fourth, if people perceive organizational goals as compatible with their own, then they will internalize company goals and goal congruence is reached. Next, coincidence between responsibility network and organizational structure. Responsibility accounting assumes that organizational control is enhanced by creating a network of responsibility centers that coincide with the formal organizational structure. Top management's intention to delegate and disperse is explained by the authority hierarchy or the organizational structure, which assigns authority and responsibility for specific duties by hierarchy levels to accomplish meaningful division of work. Next, acceptance of responsibility. The most crucial element in a successful responsibility accounting system is the responsibility center manager's acceptance of assigned responsibilities as equitable and their willingness to be held accountable. Managers' willingness to accept responsibility depends on how they perceive their discretion and control over the human and physical resources necessary to accomplish their assigned tasks. And the last is capability of inducing cooperation. Responsibility accounting improves organizational cooperation by showing managers where their activities fit into the overall picture and that everybody is working toward common goals. It also enhances company loyalty, self-esteem, and feelings of importance by allowing people to formulate their own goals and make their own decisions within the framework of delegated responsibility. Okay guys, that's all for the video. Sorry for our mistakes. Thank you for watching. Bye.